has a topic. What are we going to talk about today?
I think evaluation again.
Valuation? All right.
Think
What
it's
about
a,
valuation?
it's a hot topic. It's something that is less explained out there and a lot of confusion.
Okay.
Yeah.
So, in its simplest form, the value of the business is an equation. Okay, so we'll say V for value equals E for earnings times M for multiple. Okay, so value equals earnings times multiple. So that's in its simplest form. But valuation is both an art and a science. So when you're talking about earnings, what are you talking about? Are you talking about seller discretionary earnings? Are you talking about EBITDA? Are you talking about some other, EBIT, earnings before interest and taxes, which is seldom used, but could still be used as earnings. So one of the first things you have to do is figure out when you're referencing earnings, what earnings are you talking about? And then the multiple is kind of where, so the earnings is pretty much the science part of it. That's the math. You can go in, you can calculate EBITDA, you can calculate seller's discretionary earnings or owner's discretionary earnings, right? Because you're taking the taxable income off of the tax return, and then you're starting to add back depreciation, which, if you look on an 1120S, most of the add backs that you're going to see are going to be on that first page of the 1120S form. So I think line 13 is depreciation or interest, and you'll see interest and depreciation both on there. But so EBITDA is earnings before interest, taxes, depreciation, and amortization. So your taxable income is obviously before taxes, right? And then you add back your depreciation, your interest. The only thing not on that first page is your amortization. And if there's any amortization, that's going to be in your federal statements. So then you're going to look at other deductions on that first page, and it'll usually say see statement 1 or see statement 2. And you go to that federal statement, and if there's any amortization, it'll be identified on there. The other part of that is that you then have to talk to the seller about one-time expenses. Did the business move? If so, they have moving expenses that are only one-time expenses, so you're going to add those back. Ultimately, what you're trying to get to is operating income and operating expenses. Okay, so your earnings in whatever form, whatever the agreed upon term, whether it's EBITDA or ODE or SDE or whatever, ultimately you're trying to get to operating income minus operating expenses. Yes.
So, EBITDA, when I look at EBITDA, it's because there's a manager in place. Is that standard?
So I would say that when I'm calculating to EBITDA, it's because my buyer is going to be a family office, or my buyer is going to be a private equity firm, and they want management in place. So yes, it has to do with management in place. Now, if my buyer is going to be, my target buyer is an individual, then I'm still going to calculate to SDE, even if there is a manager in place.
Right.
Because my individuals typically are going to own or operate. Search funds, they're looking for businesses where they can be a CEO. So they're going to own or operate. So if that's my target market, then I'm going to calculate to SDE or ODE, owner's discretionary earnings. But yeah, it depends on, and it depends on who's your buyer, who's your target market, your buyer, and the size of the business. And there's some overlap. So, if the business is going to sell for, 2 or 3 million, but you're selling it to private equity, then yes, you have to calculate to EBITDA, and you don't add back the owner's compensation. And you should, if it doesn't have a manager in place, then private equity is not going to buy it.
So just to have clarity, when you've got, say a private equity wants to hire a manager for 100,000, your EBITDA is 240, your seller's compensation is 24. So you would use are you saying you don't add back the seller's compensation for EBITDA?
Well, in the event that, in the example you described, if private equity is interested, they already know there's no manager in place. They already know they're going to hire a manager. Maybe they're doing a roll up. Okay, so maybe this is part of a roll up, and they are going to put a manager in there. Then I would adjust to the delta. So I would add back the seller's compensation, but subtract out the manager. So you've got a $75,000 delta, basically, 76.
Okay.
Okay, so that's kind of the science part. Then you get to the art. And the art is in the multiple, in my opinion. Because, multiples vary per industry, but there are also risk factors that can affect the multiples, and also just the very level of SDE or EBITDA can affect the multiples. For example, if a business has $150,000 in seller's discretionary earnings, it probably will sell for 2 to 2.5 times earnings. If it has $1.5 million in EBITDA, it's going to sell for 4 to 6 times earnings or more. So that multiple is going to change depending on your level of earnings. If your earnings are only, let's say you have a small business, a little post office store or something like that, a mailbox store, and they're doing $55,000 in earnings, and seller's discretionary earnings, it's probably going to sell for somewhere in the neighborhood of 1 to 1.5 times. So, probably $75,000, $80,000. Okay. So, and then there are industries like your software as a service, any type of subscription industry with recurring revenue tends to get higher multiples. Medical device manufacturing tends to get higher multiples. So, there are industry factors that affect it. If you're looking at Main Street businesses, if you have a liquor store that's been robbed 3 times in the last 2 years, well, the fact that those robberies occurred and the location is obviously going to be, that's a higher risk to a buyer coming in, right? So that's going to reduce the multiple, because at the end of the day, the way buyers are looking at value is the higher the risk, the lower the value. So anytime you have additional risk factors, like maybe there are employees that don't have I-9s, okay, and are not authorized to work here in the state. So if that's the case, that's a high risk for a buyer. So therefore, they're going to drop the value. So there's just a lot of things that can go on that can affect that multiple, and that's why valuation is very subjective. It really is. And so yeah, valuation is super simple, right? V equals E times M. But it's not as simple when you get into the art and the science. Yeah, Pam.
Do you use a 3-year history to do your valuations, or you use, if the numbers are similar in comparison and there is a year-over-year growth, do you just use the most recent year, or do you use the average of 3?
Yeah, it depends. So I look at it from the buyer standpoint, because ultimately, we have to, right? Because so if the business is declining, buyer wants the most current year because they don't know if it's bottomed out.
Yeah.
It
Yeah.
may still continue to decline. If the business is trending upward and then buyers typically want to use an average because they don't know that it's going to continue at the same growth rate, or has the growth kind of stabilized, and is the business going to plateau. So I use whatever I think is appropriate given other risk factors and what I know about the business and what I know about, the way the business is run and so forth, and try and figure out what would be best to use. Sometimes I just use the most recent year because I feel like the business is going to continue to grow, and so that's going to be the best thing to use. But other times, I just think, we're going to use an average, or maybe a weighted average or a squared weighted average, where more of the weight is on the most recent year, but you're using
Mhm.
you're using the prior years as well.
Yeah, I
So,
like that approach. I used an average of 3.
yeah,
But then when the bank did their appraisal, they used the most current, and their value was a lot higher than mine. My
yeah,
seller was happy, but still, I feel like I, shorted him a bit. He didn't have a manager in place was the reason I was using, the multiple I was using.
yeah.
But yeah, he had a phenomenal year that last year.
And it's great if he has a phenomenal year, as long as that phenomenal year is repeatable,
Exactly.
right?
And who
So
knows, right?
yeah, well, what do his financials say? So I always do my recast off of the tax returns, and
Yes,
then I
always.
add in the P&L from the current year. So,
Yes.
at this point, I'd be looking at okay, what does my P&L say as of November 30th? Am I on track to exceed last year's results or not? And when you're at this part of the year, at the end of the year, it's much easier to identify whether you're on track and all that. If you're trying to do it in March, first quarter, there's very little you can do, because you just can't really try and annualize the year based on just one quarter's numbers. It's not going to work very well. But what you can do, if they're using QuickBooks or something else, you can always have them run a comparative P&L for the first quarter of
Mhm.
current year versus first quarter of the prior year, and see, how those compare. So there's ways to get the data,
Uh,
if like to analyze that stuff.
but yeah,
Yes, Emmer.
very subjective. So the bank, if he comes with an appraisal for the business, that's his last say. We, it's like real estate where, okay, this is a value.
The
You can,
bank, so on an SBA loan, if the loan amount is going to be more than $350,000, then the bank is required to have a professional business appraisal done.
350?
And 350, I believe it's 350,000 unless they changed it.
Okay.
The loan amount. And so the so the bank will they'll hire an appraisal. Now, if your seller has an appraisal done and tries to give that to the bank, most of the banks will say thanks but no, because I believe that the SOP for SBA requires them to go out and get an appraisal, so they're going to get their own appraisal done. If the business doesn't appraise, all they do is they'll only underwrite a loan up to the amount of whatever, 90% or 85%, depending on their lending regulations, but of whatever the appraised amount was.
Sure.
Okay.
Or
So they just adjust it. And then, because I've got one right now where it didn't appraise to what the buyer and seller had agreed to in terms of purchase price. And so the seller's just going to carry a note for 100 grand. And, you know, I guess the appraisal came in 100 grand less. And you're like,
Yeah.
okay, well. So buyer's still going to pay him. It's just going to be on a seller note with a 2-year standby. Like, okay.
But will the buyer of business really take it as, you know, would get a lot of this, like, you know, when doing real estate, the value comes under, the buyers are very emotional, especially when it comes to residential. Do
Yeah.
they take it very hard with the business if it comes less, or do they try to work it out because they really want the business?
You know, it depends on the circumstances. So, you know, in this case, it's part of the business that's being sold, not the entire business. And so just the financials and all of that, trying to split out the portion of the business that's being sold. And, you know, it's just been challenging anyways. And the buyer is very motivated and definitely wants to buy and wants to close. So he was just like, yeah, let's, you know, whatever the bank wants, let's figure out how to give them what they want so we can get the deal closed.
Yeah.
So, you know, it really does become just up to the parties to figure out. Some buyers would not. They would go back to the seller and they'd say, hey, you know, I want 100 grand. It didn't appraise, so I'm not going to pay you any more than the appraisal price. And the seller at that point, if they're motivated to sell, they might say, okay, fine, let's make that adjustment. Or they might say, well, you know, I want what I want and I'm not willing to take less. So you can either we work it out at the price we agreed on, or you can terminate and I'll
Okay.
sell to
So,
somebody else. So
so in
yeah,
that regard, it's similar to real estate. It depends on
yeah,
the buyer and the
just depends
seller.
on the parties.
Thank you.
Yeah.